I'm Shanti Gopalakrishnan, professor at the Martin Tuckman School of Management. And we'll now begin the second part of our program this evening, which is the presentations for the Strategic Management Showcase simulation. But I'd like to welcome our Board of Advisors, students, faculty, and to start off the rest of the event, the Dean of the Martin Tuckman School of Management, Dr. Reggie Codell.
Martin Tuckman School of Management, right? For those of you who don't know who Martin was a graduate from NJIT. I believe he was like 1962 from mechanical engineering, okay? Martin had not only strengths in the technology and the engineering world, but he had business sense as well. He actually totally re-energized and reinvented cargo transportation, okay? And what he did from a standardization point of view of making sure that the containers and the trucks were uniform and standardized, he actually created a new business model for freight containers. He began to lease these containers and the truck beds. And from then, it kind of revolutionized that entire industry sector. What that took was to be engaged, to understand what was going on, to be innovative, to cause change in what was going on in that world. And the third is impact. He had a tremendous impact. So engagement, innovation, impact. That's what business is all about, right? So it's extremely important that as we proceed through the understanding of business and management and how technologies have totally changed that world, to don't forget that not only must you be able to understand the technologies and deal with those and utilize those tools, but you also have to have the ability to communicate effectively, right? So presentations are extremely important, the ability to write effectively, but also to work in teams. Okay? So teamwork is an extremely important characteristic that companies are looking for. So they know you can solve the problem technically, but can you communicate your solution? Can you work with others across disciplines? So the experience that the Martin Tuckman School of Management wants to make sure that all of our students have are those type of characteristics. So a day like today is just part of that process, okay? Tonight we're joined by many different groups that have connection with the Martin Tuckman School of Management. Our advisory board is here today. So with those of you who are on the board, would you please rise and let everybody recognize you for your contributions to our programs? This board is extremely engaged with who we are as a school and the type of changes that are taking place on our campus. They are the driving force behind that. So we appreciate all of you being here tonight. How many of you are students competing in the competition for today, the Mike's Bikes? Okay. I heard some screams on the floor. Who was screaming today? Yeah, a few. Well, it's been an exciting day. We're glad that you're here, and I know that what we want to do is to move along with the program. So, Shanti, I'll turn it back over to you. And thanks again for coming. It's great to see everyone here tonight. Thank you.
Thank you, Reggie. We've had 6 teams that have been playing the Mike's Bikes simulation game since 10 a.m. this morning. And we have the results. It's been a yo-yo ride. Teams have gone up, teams have gone down. And we have their final placings. And they're not going to present in any order. They just pick their number out of a lot. And they're going to present in the order that they pick the number. Each team is going to make a 7-minute presentation. We have a group of 4 judges who are our earlier career panelists. Stephen Corral from JP Morgan Chase, Tom Watt from Pershing LLC, Letty Fabiano from Sanofi, and Michael Bush from Tracario. So the four judges will be asking questions very briefly of the presenting teams. The performance in the game will be weighted 80%, and your presentations will be weighted 20%, and we will be deciding the awards at the end of the presentations. At this point, I'd like to congratulate all the students that qualified, and I'd also say that all of you did a fabulous job, win or lose. And I think it was great that I hope you enjoyed the experience. I also would specially like to thank Ray Casetta, who gave us the idea for doing the Strategic Management Showcase 3 years ago and said he was willing to sponsor the showcase. And it's been an institution for the last 3 years. And I hope we continue to do it. And it's been a wonderful culmination for the students' 4-year program in the business school. And it sort of puts together a lot of the things that they've learned over the 4 years. So we're going to now start with the presentations. And the first group to present, you're going to be basically judged on your how you explain your past performance, your strategy, your overall creativity and style, how well you answer the Q&A that the panel poses to you. So the first group that will be presenting will be iBikes. They closed with a share price of $31.87. iBikes will be represented by Cynthia and Vlad. So iBikes, would you please come up?
Can you guys hear me? Okay. All right, so today we're going to be presenting about our performance, and our team's name is, like she said, is iBikes. My name is Vlad.
My name is Cynthia. Both of us are students in the School of Management. I'm majoring in finance and accounting with a minor in legal studies, and
I'm majoring in finance. All right, let's begin.
So I'm going to begin by touching upon our strategy during our Mike's Bike session today. So our strategy was strongly based off of our mission statement, or a mission, which is to drive the world's transition to green transportation by providing reasonably priced bikes to fulfill all of a family's needs. And as you can see, all of our performance, financial decisions, financing decisions, manufacturing decisions. Okay, thank you.
All right.
Sorry about that. Will be based off of that mission statement.
All right, and so we had a specific strategy in the beginning. We were going to go into the low-end market, and we were trying to get as much capacity as we could and really kill these numbers while keeping our margins a little low. We wanted to produce as much as we could because our bikes were, the market that we were going for, the bikes were pretty cheap compared to every other segment. But then, however, we were faced with some pretty significant challenges. And basically what happened, we had a lot of capacity, and we produced a lot of bikes in the lower segments. However, we couldn't meet the demand of the market, and we were falling behind. Our profits were crumbling. The shareholder value almost went to zero. And the main problem is there are two ways to promote your bikes, at least in the simulation. One of them being advertising, and the other one is being PR, which is public relations. And for our market, it specifically said that customers really don't care about the sensitivity for PR was very low. So we decided we're not going to spend any money. We're just going to go heavy in the advertising and take advantage of that. However, surprisingly to us, that didn't work. For some reason, PR was still a significant factor in getting the market share. And that was the big problem for us. And at some point, almost more than halfway through the competition, we had to take a radical change and completely change our strategy.
So in the year 2020, we took a radical new change to our strategy, and you can definitely see the implementation in our capacity utilization as well as our profit that we'll show later. So we began the game thinking that we're going to produce a low cost, essentially low quality, but highly profitable bikes. And we catered to that market, but what we did not realize is our advertising, our PR weren't drawing in the capacity, the production, the sales that we wanted. So as you can see, we are actually iBikes, the blue, the light blue circle. And in the year 2020, our capacity utilization was about between 50 to 60K. So during this time, we had to make some decisions, and we eventually decided to cut down the parts of our business that weren't being used. So in the year 2021, we significantly cut down our utilization, our capacity, by about 20,000. And this is where we you'll see also the difference in our profits began to occur. This is where we integrated a new strategy of producing only as much as we knew we would sell, not how much we wanted to sell.
All right, as you guys can see, from the year 2021, we were actually able to make profits. And while we had almost pretty much the lowest capacity in the whole game, we were able to turn in the second profit, which means our margins were actually one of the highest in the whole game. We only had about retails of about 30 million, while the highest team had close to 100 million in sales. And as you guys can see, we were still able to finish second, which for us was a big accomplishment because we really downsized on every single expense. We tried to be as efficient as we could, and it actually worked out pretty well.
So.
Yeah, you can go. Okay.
I know we've been speaking a lot about the strategy of our firm, and our strategy is definitely shown and portrayed through our product line. So our product line consisted of what we considered a premium product, which was the iAdventure. We sold this for about $1,700 a piece. And although we consider it premium, in the scheme of the game, this was actually a mid-market product. So our entire strategy was aimed at kind of the lower priced products. Besides the iAdventure, we had 3 economy line products, which sold at very reasonable prices, all under $415 or less. So this product line also throws our product contribution to profits from each of the products. And as you can see, the iAdventure, our premium product, contributed about half of our profits, and the other product lines almost contributed evenly, about 1/3 to the rest of the profits. So this shows our dedication to the low-cost product strategy. So we constructed a BCG matrix for our product lines. And for those of you who aren't that familiar with BCG matrices, this basically represents how profitable your products are and which ones are basically.
Can't see anything.
Oh, you can't see the picture? But I'll explain it. There's 4 categories to the BCG matrix. You can see kind of a highlight of a star. This indicates products are high in market growth rate areas, and also you have a high relative market share. There's cash cows, which have a high relative market share but aren't in a high growth area. There's actually a question mark section where iLeisure is, and these have low relative market share and high market growth rate. And lastly, there's a section dogs, which is very highlighted in light purple, where there's a low market share for our product and there's a low market growth rate. So the majority of our products were actually in between lines, and we were receiving a good amount of our cash in terms of percentage of sales from the iAdventure as well as the iKids, and that's why both of those are bordering on the line of cash cows. Our iLeisure product is something that we hope to launch to a new level coming soon because it's in a very high growth market area, although at the time our market share is not significantly more than the first competitor. And lastly, iCommuter also has the potential to move into the question area and eventually transition into either the cash cow or the star area and be a real star for our product portfolio.
Okay, and just to a little bit capitalize on our performance, as you guys can see, this is a shareholder value breakdown of every single firm in our market. And as we said before, from the year 2020, we were able to kind of jump back in the game, and we almost got to the second place in total shareholder value. And just to mention, we started with about $13 per share, and we ended up with 31. So in terms of market return, we actually had more than 100%. So if you guys would have put our money with me, you probably would be freaking out at the year end of 2019. But then we were actually able to make some pretty good decisions and get your money back. Yeah, and some key takeaways. One thing that we definitely learned is, well, first of all, never give up in anything that you do. Because at some point we were really thinking, like, there is no way back, nothing is working. But we still tried, we still put our effort and did every little thing that we could, every single adjustment in the game that could help us, and it actually did help us. So that's probably one of the biggest key takeaways from me. But also, efficiency sometimes outweighs value. And I think it's actually relevant to the market, to the current market conditions, where a lot of companies are trying to achieve the efficiency, and that's why data analytics is actually becoming a big field. And I think that's one of the things that this simulation actually proved, that you don't have to sell a lot, or like you don't have to have the most sales to be the most profitable.
So another one of our key takeaways was that superior performance can easily be trampled by complacency. I don't know if you noticed, but in the shareholder value, which this competition is based off of, we were actually first place in the first round. And maybe we didn't pay attention to the threats as much as we should have, or maybe we didn't realize certain factors as much as we should have because we were in that position. But ultimately, we realized that definitely complacency is not an option. Always look for factors that are affecting the market. Always look for what your competition will be doing. If you're doing something successful, chances are that the competition can easily pick up on these traits and market them as well. And last lesson we learned from the simulation is definitely to strategize for a particular market. Our initial strategy was based on the low-cost market, and we thought this would be an effective strategy. What we did not realize, that Vlad kind of hinted at with the public relations issue, is that this is a market simulation, and their market is not necessarily the New Jersey or the East Coast market that we're in. So the Mike Spikes market is based off of advertising as well as public relations, and there's obviously a certain formula in which they aggregate sales, profit, things like that, performance. So this translates to real life in the sense that we should have analyzed the market we were catering to more effectively instead of just looking at the market around us and try to make a strategy that theoretically made sense but was not specifically useful in this context. Thank you. Any questions?
Thank you. Sorry. So my question is specifically around your make-to-order strategy, right? So you have a make-to-order strategy, kept low inventories of raw materials. Was there ever a point in your strategy where you would have benefited from actually having had finished goods assembled for your markets?
So actually, in our last round, there was 2 rollovers to ensure that our strategy was sustainable. And when those 2 rollovers took place, we actually had some lost sales for 2 of our products, one a little more than the other. So I think if we were to kind of analyze which one had the highest growing market, we could have produced a little more accordingly.
Yeah, generally that's usually the way you strategize. You become an assemble to order for those markets that are more predictable,
Yeah.
and for the ones that.
But see, the thing with that is, like, at the first stages of the simulation, we really try to follow the market, because there is a market forecast in the simulation,
Yep.
which ended up being, like, they pretty much screwed
Forecasts
us
are forecasts. They're
up.
not 100%
Yeah, exactly.
right.
Exactly.
But
So
I
we
mean,
learned our lessons.
I applaud you because it is very creative to have an assemble to order type of strategy. But there are times that you need to shift your strategy. But that was very good.
Thank you.
We'll keep that in mind.
This way.
So I see your
Yeah.
quality ratings were the lowest out of all the teams.
Mhm.
So is that a result of your strategy of going for the lower end market?
Yeah, so our strategy was based off of the market share we targeted, and on the simulation, it actually had different characteristics, including quality, sensitivity to advertising, sensitivity to price. And the market share we're going after, their sensitivity to quality was actually very low, and sensitivity to price was either medium or high. So we tried to go for the low quality, high price market, which aligned with the preferences of the customers. What we didn't realize was that the public relations was partly related to advertising, which was something we also skimmed out on, and quality was something that overall was set as a standard by the market. So regardless of whether or not these individuals or this market was sensitive to the quality, if our peers in the simulation were producing high quality materials, our material had to at least meet that average.
And just to add to this too, when we realized that our quality was the lowest in the whole market, we actually tried to bump the numbers up and invest a lot of inspection and quality control. But what we saw is actually, instead of helping our market share, our profits pretty much, I mean, we went 4 million into the negative. And we saw that it really doesn't help us at all. And when we actually decided to downsize and we pretty much cut as much as we could, we still continued to grow in our markets and actually turned out to be profitable.
So you wouldn't have changed your decision?
Well, we probably would have played it a little bit differently from beginning and tried to go into the higher markets as well. But for the strategy that we chose, I think quality wasn't really a big issue.
Thank you.
I noticed you had 3 products on the low level of the market. Would you still maintain this strategy, or you would maybe try to come up with the one product for that market and focus on the high end?
That's another thing. I think if you're thinking about this in real world terms, it could have been successful, but in this game, if you're not going for as much market as you could, because we were already not meeting the demands. We weren't even producing so much as we could have, but even for every single market, we had about 10,000 left sales in the beginning of the simulation. So it really wouldn't helped us in terms of, because we still did not put the money in public relations, which was a big factor in capturing that demand. And then down the road, as we kept moving in the simulation, since we were already behind, it was really hard to capture that lost market. So I think we pretty much did the best we could from the point where we went down and where we had to, completely rethink our strategic management. But okay. Oh, well, go ahead. Sorry, we're gonna add to this. But if you saying from beginning, I think we still would have went to all of the lower markets, because there is a possibility to produce as much as you can. There's no limit to the capacity as long as you keep expanding. But it did not work for us.
Thank you.
Yeah. That's it. All right. Thank you, guys.
Thank you.
The next team to present would be Brainy Bikes. We have a team of 3, Shivani Patel, Bansri Patel, and Preetham Patel. Unfortunately, this team went bankrupt, and they ended up with a share price of 1 cent. So they're going to tell us what they've learned and probably how to avoid this in the future if they can.
Hello, good evening, ladies and gentlemen. We're going to be presenting Brainy Bikes, and our group is presented by me, Shivani Patel.
I'm Bansri Patel.
Preetham Patel.
And our mission statement for Brainy Bikes is providing affordable bikes for everyone nationwide. So first, we're going to talk about the market segments that was given to us in the game, and we realized a couple of things, and there was definitely many segments that we had to focus on, and each one of them were specific in their own ways. The commuter segment was very advertised conscious, and they really liked the high quality bikes. They preferred very nice specs, and the delivery time was something they were very considering. The kids, as we know, kids are very impatient, so they wanted their delivery to be very fast, and they loved TV advertising. The leisure bikes, they cared more about delivery and product specs. And the last 2, racer and adventure bikes, are the ones that we would consider in the real world as someone who was very considerate about their bikes and maybe something that they really loved doing a lot. So these people were premium customers. They wanted high quality bikes. They expected public relations, and they really were considerate of the quality and specs of the bike.
Manufacturing product utilized was 71%, and we were able to boost up to 87.4%. That was the time where we decided to not launch razors, and on rollover 4th or 5th, we decided to launch it, and that's where we did gross profit as a 71%. It increased employee as the products were developed.
So for advertising, we based advertising based on the product type. So for an example, advertising and PR were one of the main aspects of how to increase customers, increase sales. So we, like I said before, we based advertising and public relations based on each product type. For an example, the kids segment, there was more focus on advertising and not so much on PR. But for the racers and for the adventures, there's a lot more focus on public relations. We increased advertising and PR budget dramatically is when we were able, during the 4th and 5th rollover, in order to increase sales in the newly launched products. And we kept aggressively advertising and continuing our public relations until the end, as much as money allowed. So for financing, this is one of the mistakes that we made. We didn't finance early on, and we did not take on debt early enough to develop the products and build capacity. And debt is obviously really important to grow, so that's one of the big reasons why we went bankrupt early, because we didn't have enough debt and we didn't launch our products early on. The plan was to pay off debt in year 3, the 3rd rollover, but that clearly didn't happen. And we started off with 0 equity and debt, but unfortunately, due to our bankruptcy, we were injected with a $9.5 million loan. However, with our aggressive advertising and PR, we were able to end with 0 debt and equity.
All right, so product. In Adventure, Medicare sale was 9046 units out of 12,000, and which end up to 75.39%. Our gross profit margin are higher. Like I said earlier, that Racer is the one that was higher in a gross profit. It was 71%, and also for the Racer, the sales were low. For kids, the high sell was 17,669 out of 21 were sold, and the gross profit for that one was 38. So for commuters, nothing was influenced by advertising.
So, shortcomings. Do you want to go?
For our shortcomings, we did not invest early on enough, as mentioned previously, and we weren't able to develop the products and build capacity early on. We should have taken a debt of probably about $5 million the first year to support our future decisions of building more products. And so we should have started research and development on year 1 to launch in year 2. Because many of the teams in year 2 were ahead of us. They had way more products out in the market, and we were just beginning. The solutions that we found through this is that we were able to launch new products with successful returns later on. And we increased sales and product utilization by managing our quality and our training, and also advertising in certain segments. And then we were able to get out of debt eventually. For the future, we hope to earn high profits, because now that we've actually gotten ourselves out of debt, we're actually able to move on and worry about profits. We are able to balance price, marketing, distribution, and capacity more effectively. And increasing brand awareness to sell more product, because we didn't really focus in on brand awareness early on, which we can do now that we have more products. And to issue equity so we can rely less on debt for future investments. We gave out no equity, so we should have obviously done more of that to rely less on debt. And to train workers to improve product utilization even more than previously, because we were training them, but not nearly enough to have our facility working at its highest utilization. And that's the end of our presentation. Just one quick thing. On our second rollover, we actually did have technical difficulties, and that may be a poor excuse, but we were working on 3 computers, and one of them happened to go offline. And so but I know it was our mistake on our first round. We did not take on debt, but we could have possibly made up for it. So given we have future opportunities, we would definitely pull ourselves out of the hole and sell our products wisely. Thank you very much.
Hello? All right, so once you proposedly took on that debt, which product line would you invest in?
We invested in advertising after we took on the debt because we needed to sell more of the products that we were developing. So as we're developing products, we're also advertising what we did have. So 2 things, research and development and also advertising and brand awareness.
For the product lines, I think we would have focused a lot on the kids and the racers and adventures because that's where we made a lot of profit, and also we sold a lot of kids' bikes, so they brought in a lot of money. And the racers and adventures, we were able to have a higher gross profit margin on them, too.
Sorry about that.
Technical difficulty.
Yes, exactly. So you had the highest inventory value out of all the teams.
Yeah.
So what do you attribute that to? Does it go back to what you were just talking about with your public relations?
Yeah, we kind of had to focus on that after all the debt we took on. So we got a lot of products in, and we had to focus on selling those products. And we did a good job on our sales. So
Our sales were higher, yeah.
Also, we weren't able to launch our products. We should have launched them earlier. So that was a big part of our inventory too, because we should have sold. We were supposed to launch them and we were supposed to sell them earlier, but we didn't. Once again, due to the technical difficulties. So.
Okay, thank you.
So based on what you learned from this simulation, how do you think going forward you will apply this to future, I guess, opportunities, whether it's in the workforce or at school? Is there anything that you could say that would relatively apply?
I would say take the risks early and take care of the risks later on after taking on, because when you're younger, or when as a company or even as a person, when you take the risks when you're younger, you have much more time later on to make up for it and to see where your mistakes were made and how you can fix them. So in our company, when we were taking on this risk later on, we essentially had no more time left to make up for anything. So that's probably one of the advices I would or take on or give to someone. Yeah. Thank you, guys.
Thank you.
And now we have the team that won the Strategic Management Showcase. They are Cyclepath. They ended with a share price of $100. For the judges, I've misstapled them, and so they are on the third page. So it's Team 3, Cyclepath. It's represented by Edie Wu, Mike Teixeira, and Ahmed Ilahi.
Good evening, ladies and gentlemen. Thank you for coming out tonight. And before we start, I would like to thank all the groups and Dr. Shanti for offering such opportunity to us. And it was really fun. And then we learned a lot. And hopefully we can bring something to the future.
And we fought a lot.
Yeah, we fought a lot. My name is Edie Wu.
I'm Michael Teixeira.
And my name is Ahmad Ilahi.
And we are the Cyclepath. So to start off, we'd like to tell about our mission statement. Our goal was to provide customers with quality bikes for the right prices to cycle down the path with us to freedom and liberty. The first part was very important after this because we did provide quality bikes to our customers. That was very important. And later on, you would know that we kept our costs low, and it was a key to our success. So the path to success. So first of all, we want to start with marketing. You know, the goal for us was keeping our prices low, and to have a competitive advantage over the other competitors. And as the other group mentioned, we are forecasting sales and productions. And it's very important actually to look at the reports each rollover and look at what our competitors are doing, and then in order for us to keep our prices low and our ads and our public relations high in order to stay above the other groups. And as I said before, we try to be the industry leaders in ads and PR. This way, the other groups will always stay one step behind us and will always be ahead. And as the key to our success, this company, the Psychopath, was a leader in the market share. That was a key. We didn't care about shareholder value at the start, which you see, but the market share, grabbing the customers to our company, was the key.
So I'm going to talk about the factory and the operations. The main thing here, as you can see, this pie chart was very useful to us. So we didn't want to have a lot of idle time because that's going to cost us money. And also you have training. You have to make sure you train your guys to be efficient. That's going to also help with quality. Another thing was raw material, making sure we had the raw material, because every percentage that we were able to get, it was probably another $1 million in sales or more, just by 1%, because we finished around 131 million in sales. So again, we had to make sure that when we got more efficient, that we had to get rid of our factory and employees, unfortunately, to stay, not keep the idle time down low, and then now we're increasing our profit towards the end. And now the finance. In the beginning, we decided that we were going to take on debt early, so we issued stocks. We needed capital because we wanted to release bikes in every segment. We wanted to get in every segment early because that was the key. Nobody was in the segment yet, so we had to get in first. Again, we kept our ads high or PR high, so we invested in that heavily. Like I said, as you can see, we're the blue line. We decided that, let's increase revenue. Let's worry about net profit later and shareholder value later. So we just decided revenue. Let's increase market share. Let's get to 30%, 40%. So we kept our prices low. Again, towards the end, we started buying back stocks. As you can see, we pretty much gradually, we stayed pretty fairly, even along the way because we weren't as aggressive. And then towards the end, we got a lot more aggressive with buying back stocks and paying dividends. At the end, I think we paid $8.50. We wanted to pay more, but the computer wouldn't let us. Again, this is our shareholder value. Again, our strategy was sales, revenue, market share. Let's grab that. We'll worry about the rest at the end. And as you can see at the end, we got very aggressive. We started paying dividends. We also were operating at 60 to 70% margins because we were able to make our bikes so efficient and drive down the cost of our prime and drive down the SCU. So we needed less factory, and we were able to sell our bikes cheaper. And I believe everybody was chasing us with price, but not everybody was making their factory as efficient, or they were driving down their prime cost, which Ahmad will talk to you later about. Again, profit after tax. We did take a hit in the 1 year. That's because we invested very heavily in bikes. I mean, we've invested very heavily in advertising, in driving down the cost, so that's what we spent a lot of money on so we can gain more market share. And then again, as we became more efficient, profit came along.
And we're going to move on to design and development, which is a real key factor in why we were successful. Just forecasting the design, seeing what the market actually wanted, and updating our products in time, launching our products in time, and all with that, gradually reducing the prime cost so we can keep our retail price low. If you look at the charts, our prices are much lower than everybody in all the markets, most of the markets, and what that did was give us that advantage of grabbing the entire market, the majority of it, and that really got us the market share, and with the low cost, we were able to really play with the price. And that's the end of our presentation. Any questions?
So I'm going to ask you a question. When you guys made the decision to reduce your operating costs by getting rid of personnel and reducing your factory overhead. Were you all on board, or I heard at one point that you all, at certain points, may have had a little bit of infighting. So were you all on board with that decision specifically?
Yeah, when we were offline, we were doing like a lot of rollovers, and we were seeing how much SEU we were needed on like our maximum sales, and then forecasting a little bit more, because we were fine with having a little bit of inventory instead of losing sales. So if we had 2,000 or 3,000 in inventory, it was fine. I'd rather not lose sales and have some in inventory. So we were doing all those numbers. We were able to put that to the side and see what the best maximum was on the bikes and the SEU. So we were monitoring our idle time to see, okay, are we selling too much? Are we firing too many workers? So that's how we were able to adjust it. I mean, it was a little there and back, like, should we fire that? We had some fights along the way, but we got through it.
That's actually a really interesting strategy, and obviously probably one of the things that made you most effective. Congratulations, nice job.
Thank you.
Thank you. Anything you would do differently? I mean, given it was pretty successful campaign, but would you do anything differently to further increase the shareholder value and so on?
Probably be a little bit more aggressive. I mean, we didn't have that much time, and we were fighting over a lot of things throughout, more or less. But we took a hit, as you saw that, and it really took us back. We actually, believe it or not, we went bankrupt during this class competition, and we did come back pretty strong. And after it took a hit, we realized we got to do something differently. We were fighting over, should we have inventory, should we be more aggressive, or should we take on more profit? That was the key. We were arguing between market shares and profiting. Like, how do we bring back our sales? How do we bring back our customers? And then if we do something differently, we would still probably follow the same strategy and go for market shares, because I think that was important. Just towards the end, we have enough customers, we can dump at lower price, and we can pay off a lot of money for dividends and stuff.
So I see that you have the second highest long-term liabilities of 5.9 million. So where was that all going to? What attributed to that long-term disabilities?
It was a lot in inventory, I believe. And that was a loan we took out as well. And then we issued a lot of stocks. And then with the inventory, we had a lot of inventory towards the end. And
I think we just didn't buy back as many stocks as we wanted to, because the shareholder price started growing dramatically. So when we were putting in $7 to $8 million in that investment to buy back stocks, we just weren't able to buy back as many because the shareholder value was doubling each year.
One last question at the end. So your capacity was 56,000, and your maintenance expenditure was 2.3 million, which was the highest out of all teams. And your idle time was actually 15%.
Yeah.
So which of those variables would you have changed going forward, knowing what you know now?
Well, we could increase training to help with quality. That would help with the idle time. Maybe put 20 more hours on there. That would probably give us like 1 or 2% drop in idle time. And we were worried about the double rollover, not having enough capacity. So we kind of like say, okay, let's not fire anybody, get rid of any factory, because we were worried about the double rollover. But I think we could have probably been more efficient on like our supplier retention, our batch size, and maybe cutting those costs down and help us, lower those dollar figures.
thank you very much.
I have to confess, of the 6 teams that played today, this was the only team that went bankrupt in the class when we were playing it in the regular class. And they came out first in the class, and they came out first in the competition. So I guess you learn a lot from failure, and it's an important lesson to take away. Okay, the next team going up is Owili, and it is a combination of 2 teams, and it's 4 students. Their share price was $8.26. They had a very rocky ride. They, at one point, were the highest share value, and they'll tell you what happened. So the team is Kevin, Keenan, Jeremy, and DNL.
No one brought flash drives.
So as my partner DNL gets the slides up, I just want to give a thanks to first, the man Ray Casetta for funding the event, and the Business School of Management. Seriously, thanks for holding the Mike's Bikes simulation game, and of course, our dear Professor Shanti, who we are having technical difficulties at the moment. But yeah, so once again, thanks for coming, everyone. I know we could have been somewhere else, but you're here today, so thank you very much. And basically, yeah, our company is O'Wheelie. As you can see mentioned, we had a rocky start for sure, and we have a story about that. Very unfortunate. We were one of the top teams of the first 3 years, but due to heavy competition, which definitely was, we had some difficulty in our shareholder value and strategy, which we will share very soon. Other than that, is everyone here like a business major? Like anyone else who's not? Raise your hands. What major? Nice. Anyone else? Nice. All right. So we're here. O'Wheelie, now our time starts, just so let's do it.
All right, so we clearly had the most interesting turn of events during our Mike's Bikes run. So our presentation is going to focus on the per year. So in year one, we went in very blindly optimistic. We wanted to develop all of the bikes available that we could. We wanted to create a really good marketing strategy for our adventure early on. We wanted to give our retailers the bare minimum margin we could so we can maintain the most amount of cash, and wanted to focus building on capacity and quality, so mainly our manufacturing, since that's what we kind of specialized in. So in year two, we were doing really well. We were modifying our adventure. We launched our entire O'Wheelie Minus series, and we began to purchase debt and equity at this point since we had a fair amount of cash. We also pumped our advertising and our marketing for all of our bikes. And we created a focus around adventures and kids, since those are markets that we really want to try to dominate. And we also made the decision to let the commuter bikes just float out there, since we really didn't have an interest in that, but we want to be in that market. Now, in year three, there was a sort of a scramble that happened due to being overly aggressive. And this year, we wanted to buy back equity, which we did. We continued to pump more into advertising. And at this point, we had a lot of cash, so we began issuing dividends here. And we also began to focus on racers. But from here,
just like we said, year three, we got pretty excited. We're getting pretty high cash. Lunch was served. We were distracted, got aggressive, and grew too big. So year four, our value dropped, and we realized that we grew too aggressively. So we started selling our capacity. But biggest problem was we spent half our time debating on how we should go recover, and we started to focus on pretty much quality over quantity. And then year five, as you can see, started to decrease again, the O'Wheelie. And again, we tried to recover what we lost, so decrease capacity even more, and try to focus on our quality and more, again, like the higher market and higher niche market for higher quality, higher price, but low quantity.
All right, so in years 6 and 7, that's where we had our biggest drops. The biggest problem with this was we saw what our competition was doing, taking the market share and having low prices. We thought it'd be a good idea to try to lower our prices, but we were more of a quality base, and doing that hurt us. We thought that to make up for this, we should try to just inflate our shareholder value, which kind of gave us tunnel vision. We got stuck just thinking about how we could increase our shareholder value. We tried to take out capacity. We got rid of workers that we weren't using. We got rid of plant that we weren't using, and we thought that would save us money, but in the end, we got rid of a little too much, and because we decided to try to raise our shareholder value and give out dividends, we overdrafted, and we kind of put ourselves in a rut that we couldn't get out of for the 2-year rollover. This is showing of that capacity. As you can see from 2021, We had 172 employees and then dropped to 112, which we have for the next 2 years, and our total capacity SEU just dropped significantly. We weren't able to produce and make the profit that we expected to get, which then if would have gotten us out of the rut, and our shareholder value probably would have gone up. This is our balance sheet. It just shows that we were mostly an equity to asset-based firm, and we also only had liabilities for the first few years where we paid them off pretty quick, and we had our liabilities of the overdraft in the final year.
This is just a quick breakdown out as you see had income, and I just want to show how much we lost in the last year.
All right, so what we feel we did right and what we did wrong. What we did right was we created early capacity and quantity, which we later kind of threw away. We developed all the bikes and kept updating them constantly, which we felt we did really well. And we also got into buying equity and issuing dividends very early, since it was an advantage that we can make use of. However, what we did wrong, we felt that we grew too fast, and we were using too many of the resources that we acquired on various things. We doubted our original decisions and strategy to try to adjust to the competition that we didn't believe would be so heated. We were combining various strategies since we're kind of a makeshift team of what we did during our previous game. And we also continuously tried to reduce our prices to compete with others. And frankly, we sold too much and fired too much of our workers and capacity. And here's just our SVU. As you can see, if you also noted on the slides, we had a little thing on the upper right that showed how much we actually had. So you can see how we went from the top all the way to the bottom.
All right, so the real question here would be where to go from here. Obviously, we can't continue the game. But if we were to continue the game, due to the fact that we now understand each other much more and we have definitely increased our communication as a team, we would definitely pay off our debt, definitely find a happy medium in our workforce and plant capacity. As you see in our shareholder value, it just decreased dramatically from 2020 to 2013, especially with the two rollovers. Also, obviously, just leverage our position in our most successful market segments. I mean, other than that, just more time between the hours. But I think we learned a lot. We just are thankful for this opportunity, and I know that for future business settings, I have an idea of what to, do from here. Thank you. Thank you very much. Oh yeah, any questions?
Oh, yeah.
So one thing that I found pretty amazing is your brand awareness was 89.1%. So that's the highest out of all the teams. So what do you think the disconnect was between what people recognize you as a brand and what actually happened?
What we feel the disconnect was in terms of our brand awareness related to our quality. Because as we said before, we first started with quality and capacity. We were going to provide a quality and volume to the consumers, but since we were split them up, eventually we just chose one or the other, and we chose quality, but we didn't leverage that with our brand awareness. We essentially kept our brand awareness the same while just upgrading quality.
This is the team that placed 5th Aero Bikes. Their share price was at $7.11. 3 members represented this team: Mohammed Usman, Sahil Bala, and Daksh Patel.
Hello, everybody. First of all, I would like to thank you personally for being here today, and I would especially like to thank the board of directors, the dean, and our professor, Dr. Shanti, for everything. This class has been great, and I'm sure I can speak for all of my classmates and teammates here today that we've learned quite a bit from this simulation game. So we are Aero Bikes, and Our mission statement is to produce quality bikes that are readily available to a wide range of consumers at a price everyone can afford. Myself, I'm Sahil Bala, the Chief Executive Officer.
And this is Mohammed Usman, and I'm the CFO, the Chief Financial Officer.
And I'm the Production and Marketing Director, Daksh Patel.
So the main goals of our firm was to increase profit, expand business, and increase our awareness and demand, also increase our name recognition through branding, and most importantly, what we were playing for was to raise the shareholder value. And we couldn't do that at the end. So if we look at our market share is actually the second best out of all the firms. We were 21.5%. But one of the reasons why our shareholder value is down because our gross profit margin was really low because we were selling our bikes for a very cheap price.
So getting into manufacturing, our idle time was actually 0%. We got it down to 0.0%, and our factory efficiency was 87.5%. And we are very proud of that because, of course, we saved a lot of money with idle time. But at the same time, if we needed more production through demand, it probably wouldn't have been possible because we don't have any idle time remaining.
Also, I want to just add something, the training. I think the training was one of the most important thing for us because we wanted to increase our product quality with the training. The more training we give to our employees, the better bike they made, and the SEU went up with the training. And the training hours for our bike, at last year, was about 160 something hours, which I think helped us.
Which increased our overall SEU, as Mohammed's trying to say. We start off with 330, I believe, SEU, and at the end of the 7 years, we were at 420 per employee, per worker. So if we look at our multi-firm sales revenue, I know we came in 5th, but if you look at the yellow line, that's Aero Bikes, and we were actually 2nd in terms of sales. And that's because of our market share being so high. We were in 2nd. We kept our market share high in order to increase our volumes. And our strategy was to obtain the volume first and then run after the profit later. We wanted to gather as many employees as we can and make them known to our brand, and later on increase our profits.
All right, as you can see, for the profit, we're the yellow line. In the beginning, we did have a decline in net profit, but then we did increase it. And after a few years, it was decreased due to mismanaging our SCU, and that led to loss of profits.
Also, I just want to add something. We took risks. Big risk. That's the reason why our income went down. For the second year, the reason why our income went down because we produced 4 bikes, and the cost of each bike was about $100,000. So that's why our first year the income went down. But the second year, we took back, and then we got a profit, and then we started taking risks. So that's one reason why our shareholder value at the end. And also the profit wasn't really that high.
Okay, for the multi-firm shareholder values, we actually, after the year 1, we were actually close to the competition. And after year 2, they were top 3 teams. And it kept on growing, and then we took big risks, and that did not result into positive outcomes, and our shareholder value declined dramatically.
So this is just a breakdown of our net profit. As you can see, as Mohammed and Daksh repeatedly said, we took a big risk in 2018, which caused us to decline. And in 2020, we had to rethink our strategy. And as you can see, it bounced us back up, and we sort of got steady after that. Because of the double rollover, it didn't help us advance further.
Also, I want to just mention the 2020 year. One of the reasons why we went down because we reduced the cost of our bikes, the selling price of our bike, because we wanted to compete against the Psychopath, which is, their price was lower, so we wanted to compete against them.
Okay, after playing this game, the lessons that we learned was we had to balance between price, marketing, distribution, and capacity essentials. Basically, what Mohammed said, that we kept our prices so low, and that's what affected our profit.
And also one more thing that we also, our financial statements was very important. But I think I think we didn't have enough time to read everything and then start making decisions. As soon as the rollover happened, we started making decisions for next year instead of going back and looking at the financial statements from last year and where we did wrong and how we could have improved. So this is one thing we should have done.
And also one major thing is that we had the market share because our quality was the highest out of all teams. We had 96%. And we did that in order to obtain more volume. But what we were doing wrong was that we were basically selling a BMW at the cost of a Honda. So that's what brought us down in the end.
So the CEO of our company, Sahil, he preferred to make safe decision and take less risks, while Daksh was a risk taker and wanted to take big risks. And so we had a little bit fight between us, and myself was between both of them, and I was just a tiebreaker on tough decisions.
Any questions?
I have a question. Your cost of goods was extremely high. How, knowing what you know, how would you affect your cost of goods? Because it wasn't only your pricing strategy, but your cost of goods were really high.
Our cost of goods was high because we kept competing. Well, we kept wanting to compete with the top team, Psychopath. And actually, during the class game, we were actually in second place, and Psychopath ended up beating us in the last year only. We were in the first place for about 4 or 5 rollovers, and last year they ended up beating us. So this year we wanted to at least compete with them and stay with them, but we failed to do so. And that's why we invested heavily in advertising, in PR, in public relations, as well as increased our quality and made sure it was the best, and made sure we obtained volume as well. That's why we had the second highest market share.
But you would keep that strategy then and keep your cost of goods as high as you had it?
No, not for the future, no.
To be honest with you, our strategy for our class was a little bit different. Our prices in the class, when we played in the class, our prices were actually higher. But I think we made a mistake here. We changed our tactics here, and we lowered the prices here. And this is one reason why we kind of did bad.
We were going for a Walmart strategy.
Yeah.
Okay.
Okay, so first, I think it was good that you got into a little argument there and you were able to work that out. So that's just a taste of the real world right there. And so you said that you took a big risk in 2018. What was that? What do you attribute that to?
So we took a big risk we had a very high factory size, as well as our SCU was extremely high. It was close to 90,000 SCU at that time. So we wanted to increase our demand as well, because we had such a big factory. We had a lot of employees. We had 200 employees, and that was way too high from the previous year. So we wanted to increase our demand as well in order to make sure everything was flowing correctly, and so we can obtain more volume. But what happened was we invested heavily in advertising and PR, but I guess it didn't work out as we planned, and so we had an idle time of over 20%, and that's what caused us to decline.
Also, cost of the holding cost was really high because we for our inventory. Yes, so that's one reason why our profit went down.
We had about 40,000 plus bikes in inventory. Thank you.
Take this. Take it.
Now for our final presentation. This is Yeedy Bikes, named after Yeedy Wu that won the game. This team placed second with a share value of $39.25. And they really came up from 5th place, I think, and 6th place all the way back up to 2nd. And they are a very close 2nd and 3rd place. So we have 2 teams, 2 and 3, which are both in $30. So this team is represented by Chris Domi, Abi Jain, Ilano, and John Fahim.
All right, guys. How are you doing? Doing all right? We're your last group. Don't worry, we'll try to make this as fun, as quick as possible. But I'd like to thank all of you guys for dealing with us, especially my team. It was like a war zone. Thank you for not kicking us out of the management building. Anyways, now let's get started. So our bikes is called Yeedy's Bikes, as already mentioned, and our mission statement is providing premium bikes for premium clients. So we initially had a starting strategy of high quality, low volume, a high profit margin. We wanted to ideally build that Ferrari in terms of bikes, and we were gonna see how well that was gonna go, and we were ready to pivot if it failed. So some of the starting decisions we've had was take on a lot of debt. Well, a lot when I say initially we argued we were going to take 500,000. We figured that was too little. So then I think Abby said we'll take on 2 million, and we said that was too much. So we ended up taking $1 million, and that was able to put us on the spot. So with that money, we doubled our advertising and our public relations for our adventure bikes, and then we decided to create new products and new bikes for 2 different sectors, that being leisure and racers, correct me if I'm mistaken. We decided to double our capacity. We increased our quality by employee training, and we hired more employees, and we even boosted up the employee salary to figure out later that didn't make a difference. So we started increasing our retailer price and our distribution. We figured if we max out everything from the beginning, we'll be able to create that ideal product that we wanted to get going. However, it didn't turn out the way we wanted it to.
After our first rollover, shareholder value was at 9.5. We were in last place in respect to that. We started issuing shares. We entered 2 or 3 more markets, the adventure bike, the speed racer, the leisure bike, and we increased investor relations up to 500,000. After the second rollover, we started chipping away at our debt, 550,000 of 2 million. Our shareholder value was at $15.72. Going into year 3, we entered another segment, the commuter bike market. One problem we had for our first 3 years was we were paying our employees too much. We were up to $32,000 for 135 employees. It was one of our biggest expenditures. It's like $4 million going into after year 3.
So in the fourth rollover, what we did was we lowered. So we realized that the cycle paths had a price penetration strategy. We decided to lower our prices as well, try to compete with them. And then we also realized, like Yolano said, we were paying too much to our employees, and we realized that didn't matter how much we paid them. So we cut labor costs by a significant amount. We cut down advertising for leisure bikes because we realized that wasn't giving us the profits that we wanted, and we repaid all remaining debt. So our cash cow, the adventure bikes, we decided to increase our public relations for them. We decreased our branding. As we were coming to an end, we were like, we already established ourselves, so we didn't need to brand ourselves anymore. We repurchased all the shares that we had outstanding, eliminated investor relations completely, and we increased dividends to our stockholders. And the last two rollovers, our shareholder values, as you can see, jumped up 32.4 and then 39.25. We increased prices for all of our bikes because we realized that strategy wasn't working for us. We lowered our production, decreased because we were at a lot of idle time. That was our biggest problem throughout the game. We had about 16% idle time. We slowly got it down to 4% by the end of the game. We decreased our batch sizes, decreased capacity, basically downsized the entire company.
So what did this mean for us? Well, by the end, we came in second, and we were able to dip. If you follow us here, it's kind of hard to see. We're the light blue, not the light blue line. We're the light green line. So in the first year, we dipped down very much, then we went back up, and then we were down again. After that, we kind of came into our own, and that's when the last three rollovers just straight back up, with our best year being the fourth rollover, bringing us to a $25 shareholder value. Our revenues, they tended to be kind of almost on a line, almost a plateau, if you will. So those always stayed around the same. The biggest issue tended to be our own costs. We kept bringing in the same amount of sales, but the amount that we cost ourselves was increasing, and that was an issue for us that we had to deal with. So our market share was not the highest, but with our increased price, we were still able to boost our shareholder value, and from the end, and our market share was only 18% at the end.
So it's like how Apple has a 7% market share, roughly a little over, but they're still dominating the industry. Yeah, we were the Apple.
That's what we tried to be. And then, of course, as Abby mentioned earlier, we had a whole lot of idle time. This was a big deal in our game, and we kept working on this by decreasing the number of employees we had, decreasing the factory size, and increasing supplier relations to make sure that we never had stock out times.
Now, final question. Yiri, did we uphold to your name? All right, that concludes our presentation. Any questions?
You've spent a lot on advertising, on PR, just like the psychopath. Right, yet your results are a lot lower. Why do you think that is? Or let me rephrase that. You did not spend a lot on the advertisement, and your results are a lot lower. You think there is a correlation on the advertising aspect? And another second question is, you focused on the quality, but was quality really there? And did your mission statement change towards the end?
We spent more on advertising because when we played in the real class before the presentations, we actually kind of flew too close to the sun in that sense. So we were taking a little safer choice and not spending so much on advertising and PR because we were worried about overextending ourselves and just making our overhead costs just more than we could pull in retail sales.
Also, I think to add in, I think initially we were trying to spend a lot on advertising, but we didn't realize our competitors will be spending more. We thought we were going to be, up there with advertising, but we weren't, and we didn't realize the competitors will be spending as much, if not more. So then we took our strategy back and we said, we can't afford to spend this much money on advertising, so we decided to go to quality-wise and change the strategy.
And just to follow up on the second question, you think that you went away from your mission statement. Do you think it hurt or helped?
It definitely hurt us a whole lot. When we tried to lower prices, it did not work out well for us in the long run. And increasing our prices turned out to be the way to go and gave us our largest increase in revenue and shareholder value.
Thank you.
So you guys are pretty tough bosses, huh? So I noticed here that you had the highest staff turnover at 0.91, which was far, far beyond anything even close to that. And you had the lowest motivation of 0.39, which again was far, far, far below. So do you think there was any, do you think that had an impact on your results that you were so ruthless? The lowest salary out of all the groups.
Sometimes we feel if they don't do their job, we have to figure out another alternative strategy. Clearly, they weren't doing their job, which is why our shareholder value was dropped in the beginning. However, when we were doing multiple offline rollovers and we decreased our capacity to see if our strategy actually sustains, it ended up working for us, and we're like, okay, we just fired like 75% of our guys, but whatever.
Another part of the reason why we have that high turnover rate was because at the end, as you saw there, we took extreme risks and we downsized the company. I think at one point we were discussing reducing our plant size to half. So we were getting rid of everybody and everything. We're selling everything off to increase our shareholder value. So that's why that turnover rate is super high. We kind of like to think of ourselves as SpaceX, you know, just keep going, yeah. But yeah, I hope that answers your question. Thank you.
We're going to have the results in like maybe 5 or 10 minutes, and then we'll announce the results to you because we weighted the performance 80% and the actual presentations 20%. So we will give you if there is any dessert, help yourself to some dessert, some water, some coffee, and we'll give you your results momentarily. And also your checks for the participation. We have cash prizes for all 6 teams. So we will be giving out the cash prizes as soon as the judges collate their results. I'm going to ask Ray Cassetta, the brain behind the Strategic Management Simulation Showcase. He gave us this idea 4 years ago, and we implemented it for the first time 3 years ago. And this is our 3rd Strategic Management Simulation Showcase. So I'm going to have Ray Cassetta tell you a few words, and then we will give out the prizes to the 6 teams. Ray.
It was very enjoyable sitting here listening to these presentations and hearing the stories about a little bit of agony over there in the management building. Little few tug of wars on the teams. Taking risks is important. And I think all of you learned that in the course of the whole semester where you worked on this product, each week. And then to take some risks today in your short-term version of the Mike Spikes. You have to do that to succeed in life. So I congratulate all of you for doing that. I was asked to say a few words about myself. I'm a graduate of Newark College of Engineering. I took a risk in coming here. It's obviously paid off. I started out in life as a metal worker and decided later to become a college student and wound up as the student body president here, oldest one in the school's history. So the place was good to me. The president of the university at the time was good to me. And I hope as you go through with your career and become successful, and I think all of you that have gotten this far, and especially to get here tonight and make your presentations, you are all headed for a successful future. And I hope in that future, you will also remember NJIT and where you got your start. So now we have to award some prizes. And I don't have the results yet. And I don't have an envelope to open to say, and the winner is. Here they come. Thanks, Jordan.
I also want to tell you that the Bloomberg lab that all of you will be using is the Ray Cassetta Bloomberg lab. So the Bloomberg terminal lab that you see as you enter the Martin Tuckman School of Management building was funded by Ray Cassetta, and we're happy that today was the first day we sort of opened it formally. So thank you, Ray, for everything that you've done for the Martin Tuckman School of Management. The winning team gets $1,050, $350 a piece, and that's Cyclepath. The three winners are Michael Texera, Ahmed Ilahi, and Yidi Wu. Congratulations. I'm going to give you the three. The team that placed second was Yidi Bikes, and and they get $300 a piece. Ilano Tublija, John Fahim, Abi Jain, and Chris Toomey. Congratulations. Thank you. Sorry. The team that placed third was iBikes. It's a team of two people, so great work, Cynthia Ahmed and Vlad Shustov. Yes, they're making history. You did.
This is the first two-person team we've had in the competition as far as I can remember.
Yeah, the third person couldn't come in today.
Oh.
The team that placed fifth is, I forget what your company was called, Aerobikes, and it's Muhammad Usman, Sahil Bala, and Daksh Patel. I think you got $150 each. Sahil?
Congratulations.
Thank you.
I think you have the other, Muhammad?
Oh, yeah, if we get them wrong, please.
Yeah, just.
Oh, yeah, and here's yours.
Oh, they placed fourth, actually. Did I get you guys mixed up? This team placed fourth. Yeah. Oh, did you place fourth? Okay. The team that placed fifth is a team of four. Owili, Kevin Salinas, please come up. Did they place fifth? Four is Aerobikes? Okay. Oh, Wheelie? Okay. Oh, Wheelie.
That's us.
So that's Jeremy.
And where did you get
Okay, I'm going to give it to Ray to give it to you. Keenan?
Well, it was a good one. Thank you. Congratulations.
Kevin.
On one.
Congratulations. And the team that placed 6th are the 3 girls, Shivani Patel, Bansri Patel, and Preetham Patel, Brainy Bikes.
It's also the first time we've had an all-female team.
Yes,
isn't it?
I mean, I think last time too we had an all-female team
Did
that
we?
played. Yes, but yeah, but yes.
Okay.
The first.
Congratulations.
Turn around. Thank you. That concludes our program, and on behalf of the Martin Tuckman School of Management, I'd particularly like to thank Ray Casetta for sponsoring the event, for our 4 judges who have patient, and our panelists, Tom Watt, Mike Bush, Letty Fabiano, Steve Corral, our board of advisors for staying through this, the faculty and the staff that have made it possible, Virginia, Mike, Elaine, Lilia, Billy, thank you so much. And all the faculty that have stayed through, thank you. And the students that came and participated in the event, thank you so much. I hope you enjoyed it and hope you'll participate in many events like this in the future. Have a good evening, everyone.